Securities, financial planning, and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Workman and Associates and LPL Financial do not provide tax and/or legal advice or services. Please consult your tax and/or legal advisor regarding your specific situation.
Welcome to Money Talks. This is Dave Workman, and this podcast is brought to you by Workman Associates. Visit workmanassociates.com for information about the investment services, insurance, and financial planning we offer. Today is March 10th, the day after the single largest loss of points of the Dow in history. That's a mouthful. I'd like to give you my thoughts and, most importantly, set your expectations for the upcoming months. These are only my opinions, and I cannot guarantee any of my prognostications will happen. First of all, my belief is that unlike some recent market recoveries, which we call a V-shaped recovery because they go down quickly and back up quickly, this will more likely resemble a check mark with a sharp down but a much more prolonged upward movement, which means I believe the market and economy will take longer to recover. First of all, let's talk about China. We need to because it's the world's second largest economy. China's manufacturing basically shut down. I saw a picture from NASA of before the quarantines from their satellite showing the pollution from a satellite photo. And during the quarantine, and it was a 100% contrast. China was shut down. There was no smoke, no pollution, nothing. Now, China is starting to get back to work, but at a much slower pace than we expected. We now will have new demand issues. Consumers and companies are canceling events. Flights are being canceled. Cruises are being canceled. U.S. firms are fairly highly leveraged right now, meaning they have a lot of borrowed money. And with facing supply issues, meaning they can't get products to make their products, and demand issues, meaning less people buying their products, what they may do is, and what they can do, is they can cut hours, they can cut pay, and or they can terminate employees. Right now, we have a very strong labor market, and this supply and demand issue will weaken our economy. And our economy, and the world's economy, will have a difficult time recovering in the short term. Now, what a recession is 2/4 of the economy having negative growth. President Reagan used to say a recession is when your neighbor doesn't have a job, and a depression is when you don't have a job. Now, statistically, when a bear market, and a bear market is a 20% loss from the previous high, starts when the economy is not in recession, it hasn't been as long or as deep loss-wise as when a bear market starts during a recession. So what could help a recession and or the market's recovery if that comes to fruition? Well, there's a number of different scenarios and or a combination thereof. First of all, the virus wanes and more tests out there prove that the mortality rate isn't as deadly as we currently believe. I do not believe this will be the case. Secondly, we could have tax cuts. I believe something on this end will happen, but this is not a quick fix. Third, we could have a big spending package. This would take months, and this is a political issue that right now both sides may not agree on, and we have an upcoming presidential election, which may cause delays even further. Fourth, consumers and businesses learn to live with the virus. I don't believe this will happen for many, many months, but I do believe it will happen. It will take time for consumers to start getting back on planes. It will take time for China's economy to ramp up, get the products, be able to ship the products, and get them on our shelves. The fifth is that I could be totally wrong on each and every one of these. In my opinion, this is not an event. It is a problem that will take systematic changes, such as when the world learned about AIDS and how it has dealt with it, and after 9/11 and how it's dealt with it as well, i.e., we now have much more airport security and caution at airports than we did before. Because of a flight from stocks to bonds, as a whole, the bond market has rallied to the point that the 10-year Treasury, which is a bond issued by the U.S. Treasury Department in length of 10 years, it's kind of a bellwether reference point, has gone below 0.5%, lowest in its history. It is my belief that interest rates will continue to stay low for years to come. The moniker we've heard is lower for longer. Volatility will continue. Now, that may not be what you wanted to hear, but my job is to tell you what I believe. Let me give you an idea of what I believe is a future outlook. The COVID virus is here to stay. I believe we are in the panic stage now, maybe even the capitulation stage, where emotions have taken over and economics are put on the back burner when one decides how to appropriate their portfolio. I do believe that we are closer to the panic stage than the beginning. These are only my thoughts. Dealing with this pandemic and other future pandemics will be the new normal. My father was in the South Pacific in World War II, and he always told me water will find its own level. In that regard, viruses will spread. Quarantines will not work. As we now see, it has gone from China to the school districts of Avon, Indiana. It will spread, and it will have ramifications of how we handle pandemics in the future. Secondly, it looks as if today, which is the date, I believe, the Michigan Democratic primary, that Senator Bernie Sanders will not be the Democratic nominee, and Senator Biden will be. The market views this as very favorable, as Senator Sanders was seen as an antagonist and very much against many of the companies that make up our country's capitalistic system. You can look at the valuation of stocks in two ways. One is how they are priced with forward-looking earnings, and I believe they are fairly valued right now to expected earnings. Earnings are which propel stock, and for future earnings, projected future earnings are what analysts believe how the companies will do in the future, taking into account some of the things I had said. But equities are very attractive compared to current fixed income interest rates. Fourth, I believe the economy is in the throes of beginning a recession and will have a recession. This will create short to mid-term volatility. As I said, what you have heard on this podcast are my beliefs from what I've gleaned from individuals from around the world whom I've had the privilege to listen to over the last number of days. My recommendations. I've been doing this for almost 35 years, and I have never been and will never become a market timer. A plan is and always has been the best map to get through these difficult times. Secondly, do not make an emotional decision. Many of you have heard from me and will continue to hear from me. When was the last time you made a good decision when you were very emotional? And we are in very emotional times right now. Third, my recommendation is call my office with your question. And let's either discuss your plan or let's create a plan. I am in touch with whom I believe are the best money managers throughout the world on phone conferences and webinars. I've heard from our money managers in Hong Kong. For my clients, I can tell you that we have worked diligently over the past years to allocate your money into an appropriate investment vehicle because I believe that money is actually your dreams for your children, for your grandchildren's future, your retirement. As always, I appreciate your trust in business and will work hard to keep it. Please visit my website this month for video blogs about understanding what my thoughts are and about working through this difficult emotional time. This is Dave Workman, and this podcast has been brought to you by Workman Associates. Visit workmanassociates.com for information about the investment services, insurance, and financial planning we offer.